Ryan and Nathan both had $60,000 sitting in bank accounts at the start of the same year. Same amount, same starting point, same general understanding that keeping money in a bank was responsible and safe. By the end of that year, without either of them spending a dollar differently, without any market crash, without any financial disaster of any kind, one of them had quietly lost the equivalent of nearly $2,000 in real purchasing power. The other had added more than $3,000 to his position. Neither of them did anything dramatic. The only difference was where the money sat. Most people will look at this and assume Nathan, the one who came out ahead, must have taken on some risk, must have made some sophisticated investment, must have done something complicated. He did not. He made one decision that took him about 40 minutes to execute and then did not think about it again. Ryan did nothing, and doing nothing turned out to be the more expensive choice. To keep this fair, Ryan and Nathan both earn $68,000 a year. Both have stable jobs, no significant debt, and a genuine commitment to being responsible with money. Both grew up in households where keeping money in the bank was the definition of being financially smart. The only difference is that Nathan read something 6 months ago that changed how he thought about where his money was sitting, and Ryan has not read it yet. For the first few years after Ryan started earning a real income, keeping money in the bank felt like the obvious right choice. He could see it, he could access it, it was not doing anything risky. When his coworkers talked about investments in markets and portfolios, he felt a kind of calm superiority. He was not gambling, he was being prudent. His father had always kept a healthy checking account balance, and his father had never been in financial trouble. The bank felt like the adult thing, the responsible thing, the thing that people who had their lives together did with their money. The bank did nothing to correct this impression. His monthly statement showed a small interest credit, not much but something, proof that the money was working. What the statement did not show was what the bank was doing with his $60,000 on its end, what the bank was not paying him, what the gap between those two numbers actually cost him every single month he left the situation unchanged. Here is where the real cost starts to appear, and it is a cost that does not announce itself. It arrives silently, denominated not in dollars withdrawn but in dollars that were never added. The average national deposit rate on a standard checking account as of late 2025 is 0.07%. On $60,000, that is $42 per year. That is the return Ryan is getting on $60,000 of capital, $42 per year, $3.50 per month, the cost of a coffee. Inflation over the same period was running at approximately 3% annually. On $60,000, 3% is $1,800 of purchasing power lost every year. Ryan is earning $42 while losing $1,800. The net position is negative $1,758 per year, not because anything went wrong, because he is doing what he was always told was the right thing to do. This is what financial researchers call the inflation tax. It is not a line item. It does not appear on any statement, but it is the most consistent and reliable tax that exists because it charges you every single year without exception, does not require your participation, and gets larger the more money you have sitting idle. Nathan moved his money, not all of it. He kept 3 months of living expenses in his checking account, approximately $10,000, liquid and accessible for anything that came up. That is his operational cash. It lives at the bank. It earns almost nothing, and he is fine with that because its job is not to earn. Its job is to be there. The remaining $50,000 he moved into 2 places. $30,000 went into a high-yield savings account paying 4% annually. That is $1,200 per year on that portion, still liquid, still accessible within 1 to 2 business days, still completely safe. $20,000 went into a short-term treasury bill fund, yielding approximately 3.9%, exempt from state and local income taxes in most cases, with the same effective liquidity as a savings account for anyone who does not need the money within 48 hours. At the end of the year, Nathan's $50,000 in deployed capital generated approximately $2,000 in interest income. Ryan's $60,000 in checking generated $42. The gap is not because Nathan took on meaningful risk. It is because Ryan did not know the question existed. But the opportunity cost of keeping too much in the bank goes deeper than the interest differential. The second hidden cost is what that capital would produce over time if it were doing something more productive than sitting in a checking account. $20,000 invested in a basic index fund tracking the broader market at the historical average annual return of 10% becomes $51,874 in 10 years. The same $20,000 left in a checking account earning 0.07% becomes $20,140 in 10 years. The difference is $31,734. Generated not by risk, not by skill, not by any active decision, but by the simple act of moving money from a place where it earns nothing to a place where it participates in economic growth. Most people think of this as investment advice. It is actually arithmetic. The question is not whether to take risk. It is whether to participate in the slow, guaranteed loss of inflation or to accept the possibility of short-term volatility in exchange for long-term growth that outpaces it. Keeping everything in a checking account is not the absence of a financial decision. It is a specific financial decision with a specific and measurable cost. The third cost is one that most people do not consider because it requires knowing something about bank insurance that banks do not go out of their way to advertise. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor per institution. Above that number, your money in a bank failure scenario is not guaranteed. Most people reading this are nowhere near that threshold and will never need to think about it. But the people who are most likely to keep large amounts in a single bank account because the bank account feels safe are also the people most likely to eventually exceed that threshold without realizing it. The safety that felt like the point of the strategy becomes the risk embedded in it. The fourth cost is psychological, and it is the most durable one. Keeping too much money in a bank account produces a specific kind of false security. The number looks big. It is immediately accessible. It does not fluctuate. It does not send you notifications about market movements. It does not require you to understand anything. That comfort is real, and it costs real money because it removes the productive discomfort that motivates better decisions. People who keep large balances in checking accounts often describe themselves as savers. They are not wrong, but saving and growing are not the same activity. Saving is the accumulation of capital. Growing is the deployment of that capital into something that produces a return. A person who saves aggressively and deploys nothing has done half of the work and gotten a fraction of the result. Now the fair defense. Because there are real and legitimate reasons to keep more money in a bank than the conventional advice suggests, and ignoring those reasons would be dishonest. If your income is irregular, if you're self-employed or work in a field where paychecks are not predictable, keeping a larger cash buffer is not irrational. It is appropriate risk management for your specific situation. The 3 to 6 month emergency fund rule is built for people with stable, predictable income. If your income varies significantly month to month, the right buffer might be 9 months or 12 months. The cost of holding that extra cash is real, but it is the price of the insurance that buffer provides. If you are within 12 to 18 months of a major planned purchase, a down payment on a house, a business investment, a large expense you have been saving toward, keeping that money in a liquid low-risk account is correct. Money you need in the near term should not be in assets that can decline in value before you need to access them. The stock market can drop 30% in a single year. If you needed that money at the bottom, the safety of a bank account would have been worth every penny of the inflation cost. If you are in a period of genuine financial instability, job uncertainty, health issues, a business that might need cash infusion, having more liquid capital than is mathematically optimal is a reasonable trade. The cost of not having the money when you need it exceeds the cost of holding too much of it idle. The real mistake is not keeping money in a bank. The real mistake is keeping all of your money in a bank without asking what it could be doing instead, and without knowing the specific number that represents enough liquid capital for your actual life, as opposed to a vague sense that more is always safer. The answer to how much is too much is not a universal number. It is a calculation. Take your monthly living expenses. Multiply by 3 if your income is stable and reliable. Multiply by 6 if it is variable, or if your job security is uncertain. That is the number that belongs in a checking or savings account. Everything above that number is idle capital that is paying an inflation tax every month it stays where it is. The next time you look at your bank balance and feel the comfort of that number, ask yourself one question. How much of this is here because I need it to be liquid, and how much of it is here because moving it feels complicated or uncertain? Because those are two completely different reasons, and only one of them is actually protecting you. If this video showed you a cost you did not know you were paying, subscribe and hit the notification bell. Every week we break down the real math behind the financial decisions that most people make on instinct and never examine closely enough. And the next video is going to look at the specific accounts and instruments that work best for the money that should not be sitting in a bank, and why the options that sound the most boring tend to be the ones that actually work.